This book is not about getting rich quickly. It is about learning how to think clearly about money. Markets rise and fall, but human behavior stays the same. Most people lose money not because they lack intelligence, but because they lack discipline. Investing is often seen as a test of knowledge. In reality, it is a test of temperament. The biggest challenge is not choosing investments. The biggest challenge is controlling emotions during uncertainty. Prices move every day, but value changes slowly. Noise is loud, but truth is quiet. The intelligent investor learns to ignore excitement and fear. Patience becomes more important than prediction. This book teaches how to protect yourself first. Protection comes before profit. Avoiding big mistakes matters more than chasing big wins. Losses hurt more than gains help. The intelligent investor understands risk deeply. Risk is not volatility, but permanent loss. Safety comes from thinking long-term and acting rationally. Speculation feels exciting, but discipline creates wealth. This book will help you separate investing from gambling. It will show how emotions distort judgment. It will teach how to remain calm when others panic, and how to stay patient when others rush. Every principle in this book is designed to build mental strength, because strong thinking leads to strong results. Markets will always test confidence. Only prepared minds survive those tests. To become an intelligent investor, you must first understand yourself. You must recognize fear, greed, and overconfidence. You must learn why smart people still make poor decisions. This awareness is the foundation of sound investing. In the first chapter, we will explore the difference between investing and speculation. You will learn why most market participants fail to make this distinction. Understanding this difference is essential, because every intelligent investment begins with the right mindset. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. If you understand this chapter deeply, you'll never look at money, stocks, or the news in the same way again. Let's start with a simple question. Are you investing, or are you speculating? It sounds like a small difference, but it's everything. What is investing? Benjamin Graham defines investing as an operation which, upon thorough analysis, promises safety of principal and an adequate return. Let's break this down. Operation. Not a guess, not a gamble. It's a deliberate, well-reasoned action. Thorough analysis. You've done your homework. You know what the company does, how it earns money, and what it's really worth. Safety of principal. You're not trying to double your money overnight. You're trying to protect what you already have. Adequate return. You're not chasing huge profits. You're aiming for consistent, reasonable growth over time. So, investing is slow, steady, and safe. It's like building a house brick by brick. What is speculation? Speculation, on the other hand, is like rolling dice. It's buying something hoping the price will go up, but without really knowing why it should. People speculate when they buy hot stocks because everyone else is. Follow the hype on social media. Try to time the market. Invest based on gut feeling, not facts. Speculators might win big, but they can lose even bigger, especially when the music stops. Graham doesn't say speculation is evil. In fact, speculation is part of the market. But he warns, if you don't realize you're speculating, that's when the real danger begins. Why most people fail at investing. Graham says people often mix investing with speculation, and they don't even know it. Imagine a man who buys a stock at Rs 100 just because a friend said it's going to Rs 200. He hasn't looked at the company. He doesn't know what they sell or earn. He doesn't even know if the company has debt. That man isn't investing. He's guessing. He might get lucky, but luck doesn't last. The intelligent investor doesn't rely on hope. They rely on logic and research. Stock market is a voting machine in the short term. Graham says in the short term, the stock market is like a voting machine. Popular stocks get more votes and go up, even if they don't deserve to. Unpopular ones get ignored, even if they're solid businesses. But in the long run, the market becomes a weighing machine. It measures the real value of a company. That means hype fades, facts matter, and true value always rises to the surface. Eventually, emotional control, the real superpower. Let's be honest, most investors panic when prices fall and get greedy when they rise. But Graham says, the investor's chief problem, and even his worst enemy, is likely to be himself. Yes, your biggest challenge is not the market, but your own emotions. Fear when things go down, greed when things go up, FOMO when everyone else is buying. The intelligent investor stays calm. They remember the difference between price and value. The goal of the intelligent investor. Your goal isn't to beat the market every year. It's not even to get rich quick. Your real goal is to avoid big losses, to build wealth slowly, to protect your money, to think long term. If you stay focused on these, the returns will come. Chapter 2. The Investor and Inflation. This chapter may not seem exciting at first, but it's one of the most important. Why? Because it's about a silent thief. A thief that doesn't break into your house, but into your bank account. A thief that doesn't take everything at once, but slowly eats away your money's value. That thief is called inflation. What is inflation? Inflation means that the prices of things you buy, food, clothes, fuel, education, go up over time. So, if Row 100 bought you 10 apples today, next year it might only buy you 8. It's not about having less money. It's about your money buying less than before. Why it matters to investors. Here's the big problem. You work hard. You save money. You keep it in the bank, thinking it's safe. But if inflation is 5% and your savings earn only 3%, you're actually losing money every year. Benjamin Graham calls this loss of purchasing power. It's invisible but very real, and over many years it adds up in a big way. Bonds and inflation. A risky relationship. In the past, many people believed that bonds, fixed income investments, were the safest place to put money. They give you regular interest and your principal is returned after maturity. Safe, right? Graham disagrees. He explains that bonds are terrible at fighting inflation because they pay a fixed amount, no matter how high prices go. Your real income, what you can buy with it, goes down over time. Imagine buying a bond that pays us $10,000 a year. If inflation rises 6% each year, those $10,000 will feel smaller and smaller. Stocks. Not perfect, but powerful. So what's better than bonds? Common stocks. Graham explains that stocks represent real businesses, and as inflation rises, most businesses raise their prices to match. This means their profits, and eventually their stock prices, tend to grow with inflation. That doesn't mean stocks are risk-free. In the short term, stocks can crash, but in the long term, they are a better defense against inflation than bonds or cash. Historical proof. The numbers tell the story. Graham looks at decades of data to show that while inflation has gone up over time, wages have risen, corporate earnings have risen, and stock prices have kept pace. In contrast, bonds and savings have lost ground to inflation. So even though stocks are more volatile, they are also more powerful when it comes to preserving your wealth. Balanced thinking. Don't ignore inflation. Don't obsess over it. Now here's where Graham gets really wise. He says, yes, inflation is dangerous. But don't panic or make wild guesses about future inflation rates. No one can predict them perfectly. Instead, acknowledge inflation is real. Plan for it. And build a diversified portfolio that includes stocks, real assets, and maybe inflation-protected bonds, like tips in the US. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. Now imagine this. You're about to start a long journey. Wouldn't it be smart to look at the map first? That's exactly what Benjamin Graham does in this chapter. He takes us on a journey through 100 years of stock market history, not to predict the future, but to understand what's possible and what mistakes to avoid. Because as they say, History doesn't repeat itself, but it often rhymes. Let's begin. Why look at history? Graham says that to become an intelligent investor, you need a long-term perspective. Too many people base their decisions on what happened last month or last year. But when you zoom out over decades, you begin to see patterns. This chapter looks at long-term stock returns, market crashes and recoveries, investor behavior over time, key numbers, what the past tells us. From 1900 to 1970, U.S. stocks returned an average of around 9% per year, including dividends. At the same time, bonds returned about 4%. But here's the trick. These returns were not smooth or guaranteed. There were wars, depressions, booms, busts, crashes, and recoveries. Examples: the Great Depression in the 1930s, the post-war boom in the 1950s, the sharp drop in 1970 right before this book was updated. Even though the market rose over the century, there were long periods of pain. Between 1929 and 1932, stocks dropped almost 90%, but those who held on and kept investing were rewarded years later. Lesson: don't expect the market to go up in a straight line. Graham warns, people often overreact to recent performance. If the market has gone up, they think it will go up forever. If it's gone down, they panic and sell everything. But real market history shows the market is a roller coaster, not an escalator. Your job is not to predict the next twist or turn. Your job is to stay buckled in and ride it with discipline. Stock prices in early 1972. Was the market too high? In the 1972 update of this book, Graham points out that stock prices had risen a lot, maybe too much. The average price to earnings, PE ratio, was around 18, meaning people were paying Rs 18 for every Rs1 of company earnings. Graham warns investors, don't assume high prices will stay high. Don't assume recent returns will continue. Instead, ask, is the market overheated? Are people getting too excited? Are you buying stocks based on value or just momentum? Boom and bust. It always comes in cycles. Graham emphasizes a key pattern in market history. Investors get excited during a boom. Prices rise fast. People forget risk. Then comes a bust. Panic spreads. Prices fall hard. Smart investors buy during the panic, not the party. This cycle happens again and again. And if you can stay calm, when others are losing their minds, you gain the advantage. How to use this history. Graham isn't giving you a forecast. He's giving you a mindset. Here's how you use it. Set realistic expectations. No 50% returns every year. Don't chase returns based on what happened recently. Always demand a margin of safety when buying stocks. Prepare emotionally for bad years. They will come. History shows that those who stay invested and stay smart end up wealthier than those who jump in and out based on emotions. Chapter 4. General Portfolio Policy. The Defensive Investor. Now that we've seen the ups and downs of 100 years of stock market history, the big question is, what should you do with your money? This chapter is all about a very special type of investor, the defensive investor. Who is a defensive investor? Benjamin Graham says there are two kinds of investors, defensive or passive, enterprising or active. In this chapter, we focus on the first type, the defensive investor. You are a defensive investor if you don't want to spend a lot of time managing your money. You're okay with moderate returns. You value peace of mind more than chasing high profits. You're not a stock expert and don't want to become one. And guess what? That's most of us. The goal of the defensive investor. Graham says the defensive investor has a very clear goal: to avoid serious mistakes and losses. They are not trying to beat the market. They just want steady growth, low stress, and a solid sleep at night. What should be in your portfolio? Here comes the most important advice of this chapter. Graham says a defensive investor should always have a mix of two main asset classes: high-grade bonds or government securities, common stocks, shares of strong companies. And here's the golden rule. Keep a balance between 25% and 75% in each. Usually, 50% stocks and 50% bonds is ideal. But Graham gives you flexibility. If stocks feel too risky, go 25% stocks and 75% bonds. If stocks are cheap and you're okay with some risk, go 75% stocks and 25% bonds. Just never go all in on one thing. That's gambling, not investing. Why this balance matters. Let's say stocks crash badly. If you had 50% in bonds, they protect you. If stocks rise fast, your 50% share in stocks grows with the market. This balanced approach reduces emotional panic, smooths out big ups and downs, keeps your long-term goals safe. Even Warren Buffett says, Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. That's the heart of a defensive investor's mindset. What makes a stock safe? You can't just pick any stock and call yourself safe. Graham says a defensive investor should only buy stocks of companies that are large and well-established. Have a long record of steady earnings, at least 10 years. Pay regular dividends. Have a strong financial position, low debt. Are not overpriced. In short, stick to boring, proven winners. Think of companies like Coca-Cola, Unilever, Johnson & Johnson, not some hot new startup. How often should you review your portfolio? Graham says, not too often. Once or twice a year is enough for most people. The goal is to rebalance your portfolio, bring it back to 50-50 if it drifted. Replace any investments that no longer meet the criteria. Don't react to every news headline or market dip. Markets go up and down, but your plan should stay strong. Common mistakes. Defensive investors should avoid. Trying to time the market. Don't guess when to buy or sell. Stay invested consistently. Chasing hot stocks or tips. Just because everyone is buying it doesn't mean it's smart. Being too conservative or too aggressive. Don't put all your money in bonds or all in stocks. Stick to balance. Panicking during crashes. Defensive investors prepare for crashes before they happen by having bonds and discipline. Chapter 5. The Defensive Investor and Common Stocks. In the last few minutes, we understood that the defensive investor should own some common stocks, but be extremely careful in how and what kind they buy. Let's now go deeper into how to apply these rules in real life. The Graham Criteria, Step-by-Step Stock Selection Guide for Defensive Investors. Benjamin Graham lays down 6 criteria that help defensive investors choose stocks that are reliable and safe. Let's break these down. 1. Adequate size of the company. Graham recommends investing in large companies, not small startups. Why? Because large companies are more stable and less likely to go bankrupt. As a basic filter, a company should have at least $100 million in annual sales. In today's terms, think even bigger due to inflation. In simple words, don't buy shares of a tiny company nobody's heard of. Stick with giants who've proven their strength. 2. Strong financial condition. The company should have plenty of current assets, cash, inventory, receivables, low levels of long-term debt. Graham suggests a quick test. The company's current assets should be at least twice its current liabilities, and long-term debt should be less than the stockholders' equity. Why? Because in hard times, financially healthy companies survive, while others crumble. 3. Earning stability. The company should have earned positive profits in each of the past 10 years. Not just good years during a boom, but steady profits even in recessions. This shows that the business is resilient and can handle market storms. If the profits keep disappearing during downturns, it's a red flag. 4. Dividend record. The company should have paid uninterrupted dividends for at least 20 years. Why is this important? Because a regular dividend shows consistent earnings, a management team that respects shareholders, a stable business model. Avoid companies that don't pay dividends at all, or only started recently. 5. Earnings growth. Over the past 10 years, the company's per-share earnings should have increased by at least 1/3. That doesn't mean fast growth, just steady upward movement. This proves the business is expanding, even if slowly. 6. Moderate price ratios. Graham puts clear limits on how much you should pay. Price to earnings, PE, ratio should be 15 or less. This means the stock price is no more than 15 times the average of its earnings. Price to book, PB ratio, should be 1.5 or less. This means the price is no more than 1.5 times what the company's assets are worth. And if you multiply PE x PB, it should be under 22.5. Example: if a company has a PE of 10 and PB of 2, 10x2 or 20, then good. If it has a PE of 30 and PB of 1.5, 45 too expensive. Putting it all together, a defensive investing strategy. Here's how a defensive investor can create a strong and simple plan. Split your money, 50% in bonds, 50% in stocks, or adjust depending on market conditions. For the stock part, either. Buy a low-cost index fund like SP 500 or Nifty 50, or pick 15-30 stocks that meet all 6 Graham criteria. Rebalance once or twice a year. That's it. Avoid checking prices daily. Let the plan work quietly in the background. But what if the market crashes? Great question. Graham says, it doesn't matter. If you've selected strong companies, you should hold on, or even buy more when prices are low. That's the beauty of being a defensive investor. You don't panic. You're not trying to predict tomorrow. You're building wealth slowly, safely, and steadily. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Imagine you are an investor who doesn't just want to sit and wait like a defensive investor. You want to work a little harder and get better returns. This chapter is for enterprising investors like you. But Benjamin Graham starts with a warning. Just because you're more active doesn't mean you should take unnecessary risks. In fact, being enterprising doesn't mean chasing every shiny stock. It means being selective, disciplined, and avoiding mistakes that come from hype or excitement. Let's break it down simply. What not to do? The negative approach. Graham opens this chapter by telling enterprising investors to first eliminate the bad habits and poor strategies. If you can avoid losing, you've already won half the battle. Here are the big don'ts for an enterprising investor. 1. Don't invest in new or unproven companies. It might seem exciting to get in early on a brand new company, but most new businesses fail. Graham says, don't risk your money on dreams. You should invest in reality, not imagination. Hope is not a strategy. 2. Avoid hot industries. Tech booms, AI, crypto, biotech. Sure, they sound exciting. But Graham warns against investing just because something is popular. When everyone is talking about it, chances are it's overvalued. It's like buying tickets to a concert after the artist is already on stage. You'll pay too much and get a bad seat. 3. Don't buy stocks without strong financials. If a company isn't making profits, has too much debt, or has wild fluctuations in earnings, stay away. Even if the story sounds great, the numbers must support it. Graham says, focus on earnings, assets, and history, not on buzz or forecasts. 4. Avoid IPOs, initial public offerings. When companies first offer their shares to the public, the excitement often leads to inflated prices. Graham advises waiting until a company has proven itself over time before considering it. Think of it like dating someone new. Get to know them before making a lifelong commitment. 5. Don't rely on forecasts or predictions. No one can predict the future of the stock market, not even the smartest analysts. Graham urges you to base your decisions on facts, not guesses. The future is uncertain. Focus on what you can control, price and value. Key principle: protection. First, profit second. Graham's approach is always about preserving capital. His philosophy is simple. Make sure you don't lose money. Then worry about how much you can make. This negative approach is about filtering out the bad choices. Once you remove them, what remains is a smaller pool of safe, solid opportunities. Enterprising doesn't mean gambling. Graham is not against working hard for better returns, but he wants you to work smart, not wild. Being enterprising means studying businesses deeply, checking balance sheets, understanding long-term trends, comparing companies carefully. It's more like being a detective than a gambler. Chapter takeaway. A good investor knows what to avoid as much as what to choose. This chapter trains your eyes to spot traps in the market. Avoiding poor investments is the first step toward intelligent investing. Chapter 7. Portfolio policy for the enterprising investor. The positive side. So far, Benjamin Graham talked about what the enterprising investor should avoid. Now in Chapter 7, he flips the coin and talks about what they should actively do. The positive side. If you're someone who wants more than just average market returns, this chapter is your guide. Let's break it down in simple points. Who is an enterprising investor? Someone who is willing to spend more time and effort researching investments. Accepts some risk to aim for better than average returns. Doesn't blindly follow the market or hot trends. Graham is clear. Discipline, patience, and rational analysis are key. You can't just chase excitement and expect long-term gains. Main strategies for the enterprising investor. Here are 5 smart strategies Graham suggests for those who want to take a more active investing route. 1. Buying undervalued stocks. Bargain issues. Graham's favorite. These are stocks that are priced way below their real value. For example, a company with assets worth $100 per share selling for $50. These are often ignored by the crowd and may be struggling short-term, but are fundamentally solid. This strategy requires deep research, but offers huge upside potential. Think, you're buying $1 coins for $0.50. 2. Special situations and workouts. These are opportunities like mergers, liquidations, restructurings, corporate spin-offs. The goal is to profit from the price movement that follows these events. Example: if a company announces a merger and its stock is undervalued, you might profit once the merger completes. Requires high knowledge and attention to detail. 3. Investing in relatively unpopular large companies. Graham suggests looking at big companies that have fallen out of favor. Example: low profits, bad press. The crowd ignores them, so their price drops, but their underlying value might still be strong. These are like sleeping giants. Once they bounce back, the returns can be solid. Strategy: be a contrarian. Buy what others are avoiding if it has potential. 4. Buying into net stocks. Very rare today, but used by Graham a lot. These are companies where cash and liquid assets alone are worth more than the market price. It's like buying a company for free and getting its assets and business as a bonus. Graham found massive returns in these during the Great Depression and post-war periods. Tip: requires careful balance sheet analysis. 5. Intelligent growth investing. Graham warns against blindly chasing growth stocks, but he acknowledges that with rigorous analysis, you can find growth companies that are not overpriced, have solid fundamentals, have a good margin of safety. Rule: growth is good, but only when priced right. Important advice from Graham. Always keep an eye on valuation. Just because a stock is cheap doesn't mean it's good. Just because it's growing doesn't mean it's safe. Use these tools. Price to earnings, PE ratio. Debt levels, asset values. Past earnings stability. Industry comparison. The emotional side. Even as an active investor, Graham reminds us, don't follow fads or panic during dips. Stay rational when others are emotional. Always have a long-term mindset. Remember, the biggest enemy of the investor is not the market. It's your own emotions. Chapter 8. The Investor and Market Fluctuations. Let's imagine you're at an amusement park. You buy a ticket for a roller coaster, not because you enjoy stomach-churning drops, but because you trust the ride to bring you back safely. That's how Benjamin Graham wants you to think about the stock market. It will go up and down, but don't scream at every dip. Understanding market fluctuations. Markets are emotional, Sometimes they're extremely excited, bull markets, and sometimes deeply depressed, bear markets. Prices rise and fall, not always because of company performance, but often due to investor psychology. This is normal. Graham introduces a powerful metaphor, Mr. Market. Imagine the stock market as a business partner who offers to buy or sell his share to you every day. Sometimes he's euphoric and offers high prices. Other days, he's depressed and offers bargain prices. The intelligent investor doesn't let Mr. Market's mood control them. They use his mood swings to their advantage. Your job as an intelligent investor: don't react emotionally. Don't sell when prices fall out of fear, and don't buy just because everyone else is euphoric. Be rational. Use market fluctuations to your advantage. When stocks are overpriced, sell a little. When they're underpriced, consider buying more. Avoid market timing. Trying to guess the top or bottom is like trying to catch lightning, almost impossible. Instead, practice discipline and consistency. How to react to price changes. Bad approach. Oh no, my stocks are down 10%. Should I sell? Good approach. Stocks are cheaper now. Let me evaluate if I should buy more. Market fluctuations only matter if you plan to sell. If you're investing for the long term, short-term movements are just noise. Graham's golden advice: you are neither right nor wrong because the crowd disagrees with you. You are right because your facts and reasoning are right. This means stick to facts, not feelings. Tools for the intelligent investor. Dollar cost averaging. Invest a fixed amount regularly. You buy more when prices are low and less when they're high. Margin of safety. Always keep a buffer by buying undervalued assets, so even if things go wrong, you're still protected. Intrinsic value. Market price. Focus on a company's real value, not what the market says it's worth today. Final thought. Markets are like weather, unpredictable and constantly changing. But a wise farmer doesn't cry every time it rains or snows. He adjusts, stays patient, and waits for the harvest. So too should you. Be the calm, intelligent investor. Let others ride the emotional roller coaster. You just enjoy the park. Chapter 9. Investing in Investment Funds. Welcome to Chapter 9, where Benjamin Graham answers a question that many investors, especially beginners, often ask: should I invest in mutual funds or do it myself? Let's dive in. What are investment funds? Investment funds, especially mutual funds, are pools of money collected from many investors. A professional manager then invests this money into a diversified portfolio of stocks, bonds, or both. On the surface, they seem perfect for people who don't want to research stocks themselves. But Graham wants you to look deeper before trusting your hard-earned money to them. What the intelligent investor should ask. Before jumping into a mutual fund, ask: how has the fund performed over time? Is the manager consistent and disciplined, or chasing trends? Are the fees and expenses justified by the performance? Myth: professional managers always beat the market. Graham's research shows that most mutual fund managers do not consistently beat the market. In fact, many underperform when you include fees, taxes, and trading costs. Why? Managers often chase hot stocks. They might act emotionally or react to short-term noise. And many funds are too big, making it hard to move in and out of stocks efficiently. Fees eat your profits. Let's say you invest $100,000 in a fund that earns 10% annually, but charges a 2% management fee. That means you're really earning only 8%, while the manager keeps 2% every year. Over 20-30 years, that difference can cost you lakhs, or crores, in lost returns. Graham's advice: avoid high-fee, actively managed funds unless their long-term track record justifies the cost. The best option for most people: index funds. Graham was ahead of his time. He strongly hinted that the best choice for most investors is to invest in low-cost, passively managed index funds. These funds simply track a stock market index, like the SP 500 or Nifty 50. No guessing, no hype, no emotion. Advantages: very low fees, broad diversification, simple and effective. Historically, they beat 80–90% of active mutual funds over long periods. Even Warren Buffett, Graham's most famous student, recommends index funds for most investors. So, when might active funds make sense? Graham says you can invest in active mutual funds if the fund has outperformed consistently for many years. The manager has a clear, repeatable strategy. The fees are reasonable. You understand what the fund is doing and believe in its discipline. Still, he urges caution. Past performance isn't a guarantee. Graham's final advice for enterprising investors: if you're willing to do your own homework, you can sometimes find smaller, under-the-radar funds. Specialty funds, e.g. those focused on distressed assets or international value stocks. But even then, apply strict selection rules and don't chase the latest star. Chapter 10. The Investor and His Advisors. In this chapter, Benjamin Graham talks about a question every investor faces. Should I take help from a financial advisor or go it alone? Let's explore what Graham wants you to understand. Who is a financial advisor? A financial advisor is someone who offers you guidance on where to invest your money, how much risk to take, and how to build your wealth. Sounds helpful, right? But Graham wants you to pause and think. Why be cautious? Many so-called advisors may not actually be looking out for your best interest. They might try to sell you products that benefit them, not you. Suggest complex plans that sound smart but are full of hidden fees. Push you into speculative investments rather than solid, safe strategies. So Graham tells us, just because someone sounds confident or works for a big company doesn't mean they're truly intelligent or ethical. What makes a good advisor? Graham gives us a checklist for recognizing a trustworthy financial advisor. Competence. They understand the market and long-term investing, not just chasing trends. Integrity. They're honest and will tell you when they don't know something. Objectivity. They don't push products for personal gain. Alignment with your goals. They tailor advice based on your needs, not some generic formula. In short, a good advisor is a guide, not a salesperson. When should you get an advisor? Graham says it's okay to seek help if you have little time or knowledge about investing. You want a second opinion. You're prone to emotional decisions like panic selling, but even then, you must stay involved. Never fully hand over your financial future to someone else. Be an informed investor. What if you're going solo? If you choose to be your own advisor, Graham supports it, as long as you're willing to learn. His entire book is designed to make you a more confident and intelligent investor. So if you've read this far, you're already taking the right steps. One timeless advice. Graham warns, don't expect anyone to make you rich. Whether it's a fancy advisor or a hot stock tip, there are no shortcuts in investing. It takes patience, research, rational thinking, and a margin of safety. Key takeaways. Be skeptical of flashy advisors. Many care more about their commissions than your money. A good advisor educates and empowers you, not controls you. If you do it yourself, be willing to study and think long term. In investing, there are no magic wands, just sound principles. Chapter 11. Security Analysis for the Lay Investor. General Approach. In this chapter, Benjamin Graham focuses on how a non-professional, or lay, investor can analyze stocks without needing to be a Wall Street expert. He encourages the average investor to apply logical, common-sense techniques to choose good investments. Let's simplify the key ideas. What is security analysis? Security analysis is just a fancy term for studying a company and its stock before investing. Graham says, you don't need to be super smart, you just need a rational, disciplined approach. So, how should a common investor analyze a stock? The 3 key factors to analyze. Benjamin Graham breaks it down into 3 big questions. 1. Is the business fundamentally sound? Is it making regular profits? Does it have too much debt? Is it stable and likely to survive bad times? 2. Is the stock reasonably priced? Even a good company can be a bad investment if the stock is overpriced. So Graham says, don't just fall in love with the business, look at the price. 3. Does it have a margin of safety? This is Graham's golden rule. If you're buying something for $70 that's worth $100, you've got a $30 safety cushion. That protects you from errors or bad luck. Don't try to be a prophet. Graham warns us not to guess the future. He says, the investor's chief problem, and even his worst enemy, is likely to be himself. Trying to predict which stock will double next year is risky and speculative. Instead, focus on companies with solid past performance, strong balance sheets, and sensible pricing. Use simple, proven criteria. You don't need a PhD in finance. Graham suggests checking. Earning stability. Has the company been profitable in at least 8 out of the last 10 years? Strong financial condition. Enough cash or assets to pay off debts. Dividends. Has it paid consistent dividends for 20+ years? Moderate P/E ratio. Don't overpay. Look for companies trading at no more than 15x earnings. Reasonable price-to-book ratio. Stock price should not be too high compared to its book value. These rules filter out weak or speculative stocks automatically. The role of common sense. Graham repeats that a lay investor shouldn't feel inferior. You don't need to time the market or find secret stocks. Instead, ask yourself, would I still buy this company if the market closed for 10 years? Would I be comfortable owning it long term? Am I buying this stock because it's popular or because it's solid? Invest in what you understand. Never invest in something just because someone else is doing it. If you don't understand what a company does, how it makes money, and why it will likely continue, then don't buy it. Warren Buffett followed this exact advice from Graham and made it the heart of his strategy. Chapter 12. Security Analysis for the Lay Investor. General Approach. Imagine you're at a grocery store. You want to buy apples, but you're not just looking for shiny ones. You want good quality and fair price. That's what Benjamin Graham says investors should do with stocks too. In this chapter, he gives the average person, the lay investor, a very practical approach to analyzing a stock before buying it. The main idea. Graham says you don't need to be a math wizard or a finance expert to analyze stocks. What you do need is a logical, careful, and consistent process. You should treat every stock like a small piece of a real business, and only invest if that business makes sense to you. What should you look at? Graham lists 5 key factors that any intelligent investor should examine. Earnings. Is the company consistently making profits? Look at the last 5 to 10 years. One good year doesn't make it a great company. Stability. Are the earnings growing steadily, or are they bouncing up and down like a yo-yo? Dividend record. Has the company been paying dividends regularly? A steady dividend history shows the company rewards its shareholders. Financial strength. Does the company have too much debt? Can it survive a bad year? Price. Is the stock cheap compared to what the company earns, called the price-to-earnings ratio, or P/E? A lower P/E often means better value. Graham's golden rule. Don't overpay. Even the best company can be a bad investment if the stock is too expensive. Always make sure the price is reasonable based on the company's actual performance. Real-world example. Think of it like buying a small business on your street. Would you pay $10 million for a shop that earns $50,000 a year? Probably not. The same logic applies to buying stocks. Why this matters? Most people either follow hot tips or buy what's popular. Graham warns against this. He says, popularity can fade, but fundamentals last. By using his simple checklist, even an average investor can avoid big mistakes and make smarter choices. Bottom line, you don't need to be brilliant. You just need to be disciplined and logical. Study a company like you're buying the whole business. If it's solid, stable, and fairly priced, then it's worth investing in. Chapter 13. A comparison of 4 listed companies. In this chapter, Benjamin Graham takes us into a real-world comparison of 4 actual companies. Why? Because learning investment theory is not enough. You need to see how that theory plays out with real businesses. Graham wants to show you how to think like an investor, not a speculator. What's the goal of this chapter? To help investors understand how to read financial statements, what kind of questions to ask about a company, why surface numbers, like earnings per share, can be misleading. He teaches this by analyzing 4 companies, unnamed here, but representing different industries, sizes, and performance levels. What Graham analyzes in each company. 1. Earnings history. He looks at whether the company's earnings are consistent or erratic. A company with 10 years of steady profits is often safer than one with extreme ups and downs. Key lesson: avoid companies with wild earning swings. Predictability is your friend. 2. Growth trends. Graham checks how fast the company has grown over time, but more importantly, whether that growth is sustainable. He warns, just because a company grew fast last year doesn't mean it will next year. Key lesson: don't chase past growth. Focus on long-term stability. 3. Financial position. He looks at how much debt the company has and whether it has enough cash and assets to survive a downturn. Red flag: a company with too much debt is like a person living on credit cards. 4. Dividend record. Does the company regularly reward its shareholders with dividends? Companies that pay consistent dividends often have good cash flow and strong management discipline. Key lesson: dividends can be a powerful signal of financial health. 5. Price and valuation. Graham compares each company's stock price to its earnings, book value, and other fundamentals. Sometimes a slower growing company might be a better value than a hot tech stock if it's cheaper and more stable. Golden rule: price matters. A great company is a bad investment if you overpay. Real takeaway for you: the intelligent investor. This chapter isn't about memorizing financial terms. It's about learning to think critically about a company. Don't fall for hype. Don't trust just one financial metric. Ask deeper questions. Is the business solid? Is the price fair? Can it survive bad years? Thought experiment. Imagine you're buying not just a stock, but the entire business. Would you be comfortable owning it for the next 10 years, through good and bad times? Chapter 14. Stock selection for the defensive investor. Imagine you're someone who wants to invest your money, but doesn't want the headache of tracking every up and down of the market. You're careful, calm, and focused on safety. That's who Benjamin Graham calls the defensive investor. In Chapter 14 of The Intelligent Investor, Graham gives a step-by-step guide on how this kind of investor should select stocks. Let's break it down in the simplest way possible. Goal of the defensive investor: to minimize risk and maximize peace of mind, even if that means not chasing the highest returns. You're not trying to beat the market. You're trying to protect your capital and grow it steadily. Graham's 7 golden rules for selecting stocks. These are like a checklist. Follow this, and you'll avoid most traps. 1. Adequate size of the company. Don't go for tiny startups or micro companies. Look for large, stable, and established firms, at least $100 million in annual sales. In 1970s terms, adjust for inflation today. 2. Strong financial condition. For industrial companies, current assets should be at least double current liabilities. Current ratio is less than or equal to 2. For utilities, debt should not be more than twice equity. Translation: the company should be able to easily pay its short-term bills and not be drowning in debt. 3. Earning stability. The company should have positive earnings, profit, in each of the past 10 years. This shows it can survive different economic cycles. 4. Consistent dividend history. Should have paid dividends for at least 20 years, no interruptions. Even if you don't care about dividends, it shows the company values its shareholders and is financially healthy. 5. Earnings growth. At least a 33% increase in per-share earnings over the last 10 years. Not rapid growth, but slow and steady wins the race. 6. Moderate price to earnings, P/E ratio. P/E ratio, price divided by earnings per share, should be no more than 15. Avoid overpaying for stocks. 7. Moderate price to assets ratio. Price should be no more than 1.5 times book value, assets minus liabilities. But there's flexibility. If PE is lower than 15, this can be slightly higher. Formula: PE ratio x price to book ratio should be less than 22.5. What does all this mean? These rules help you filter out overhyped companies, companies with poor fundamentals, companies that might collapse in a downturn. Graham believed that following these rules could lead to better than average returns with far less risk than speculative investing. Real-world tip: you don't need to find perfect companies that meet all 7 rules 100%. Even finding companies that satisfy most of these criteria can dramatically lower your risk. Chapter 15. Stock Selection for the Enterprising Investor. Who is an enterprising investor? Before diving in, remember, an enterprising investor is someone who is willing to put in more time, effort, and research than a defensive investor. They seek above-average returns, but without gambling. So how do you find good stocks without taking on excessive risk? Graham gives us clear, rule-based filters, not guesswork or hype. Graham's stock selection rules. These rules are like a checklist. Graham suggests investors buy only those stocks that meet several or all of the following criteria. Rule 1. Adequate size of the enterprise. Pick medium to large companies. Tiny companies may be tempting with their rapid growth, but they also come with higher risks and less stability. Bigger companies are better at surviving economic shocks. Rule 2. Strong financial condition. The company's current assets should be at least twice its current liabilities. Also, long-term debt should be less than the net current assets. Why? Because financial health means less chance of collapse. Rule 3. Stable earnings history. The company should have shown positive earnings for at least the past 5 years. No frequent losses or erratic profits. If a company can't be consistently profitable, it's not reliable. Rule 4. Dividend record. It must have paid a dividend for at least the last 20 years. Graham isn't just looking at profits. He wants companies that return value to shareholders. Rule 5. Earnings growth. Look for a minimum increase of 1/3 in per-share earnings over the past 10 years. This shows the company is growing at a healthy, moderate pace. Not too fast to crash, not too slow to stagnate. Rule 6. Moderate price-earnings ratio, PE. Graham suggests the current price should not be more than 15 times average earnings of the past 3 years. This ensures you don't overpay for hype or temporary results. Rule 7. Moderate price to book value. The stock price should not be more than 1.5 times the book value, assets minus liabilities. If the PE is low, Graham allows a little flexibility here. Basically, don't pay $100 for something worth $60 on paper. Combining the rules. Graham says you don't have to meet every rule, but the more a stock satisfies, the safer and sounder it is. This method weeds out speculative, overpriced, or weak companies and highlights undervalued opportunities with strong foundations. Thought experiment. Imagine you're walking through a supermarket. One section has well-packaged, branded goods priced at fair rates with solid reviews. Another has flashy items with wild price tags, some incredibly cheap, some extremely expensive. But no clear info about what's inside. Where would a smart buyer shop? Exactly. Graham's rules help you shop smart in the stock market. Additional Graham tips. Be patient. Don't jump on a stock just because it's cheap. Make sure it meets multiple filters. Avoid growth at any price. Don't pay premium prices for companies just because they're growing fast. Stick to your criteria. Your brain might be tempted by hype, but your checklist keeps you disciplined. Chapter 16. Convertible issues and warrants. Imagine you're at a buffet, and they offer you a plate that not only lets you eat what's already on it, but also gives you the right to come back later for a better dish at today's price. That's exactly what convertible securities and warrants are in the investing world. Benjamin Graham, in this chapter, warns the intelligent investor to tread carefully when it comes to these fancy-sounding financial instruments. What are convertible issues? Convertible bonds or preferred stocks are like financial chameleons. They start out as fixed income instruments, like bonds, but they have the option to be converted into common stock of the same company. For example, a company may issue a bond worth $1,000 that can later be converted into 20 shares of the company stock. Pros: fixed income, interest or dividend until conversion. Opportunity to convert and benefit if the stock price rises. Cons: lower interest rates compared to regular bonds. If the company performs poorly, you're stuck with a bond and the shares might be worthless. The company often prices them attractively to itself, not you. What are warrants? A warrant gives you the right to buy stock at a certain price in the future, but not the obligation. Think of it like a coupon that allows you to buy a shirt at $500, even if its market price becomes $1,000 later. Why companies issue warrants? To sweeten the deal for investors. To raise money without immediately diluting ownership. Graham's warning: speculative by nature. Most warrants are just like lottery tickets. Rarely work in the long run for small investors. Graham's core message: these financial tools often look appealing, but are structured to benefit the company or insiders more than you. He says, only professionals or advanced investors who can analyze deeply should touch convertibles or warrants. For the average investor, these are high-risk tools disguised as low-risk investments. Example for you. Suppose you bought a convertible bond in a tech company in 2020. The bond gives 3% interest per year and can convert into 10 shares if the stock crosses $200. By 2025, the stock rises to $500. You convert, and now your total return is huge. Sounds great? Yes, but only if the company survived. If the company had tanked, you'd have neither good bonds nor valuable shares. Graham's final advice: don't chase high returns promised by convertibles or warrants unless you understand the risks fully. Most are just marketing tricks that lead to overpaying for hype. A defensive investor should completely avoid them. An enterprising investor should only very selectively consider them, and only with deep analysis. Chapter 17: 4 extremely instructive case histories. In this chapter, Benjamin Graham does something very important. Instead of just talking theory, he takes us through 4 real-life case studies. These aren't just stock stories. They're lessons in how investors win or lose based on their decisions and mindset. Let's break it down in simple terms. Why case histories matter. Many books give you abstract advice, but Graham says, let me show you real examples where people either succeeded or failed, and why. These stories are like looking into the X-ray of a decision to understand what worked, what didn't, and what we can learn from it. Case Study 1: the reluctant convertible bonds. A company issued convertible bonds, bonds that can turn into stock. On the surface, it looked like a great deal, fixed income now, and potential to convert into rising stock later. But Graham shows how investors didn't properly analyze the company's real earning power. Lesson: just because something sounds like a hybrid deal, bond plus stock upside, doesn't make it safe. Analyze the company's fundamentals before believing in the potential. Case Study 2: the hot electronics company. Here, investors chased after a booming electronics company. The stock price was sky high, not because of real profits, but because people thought it was the future. It crashed hard. Lesson: hype doesn't equal value. The intelligent investor doesn't follow excitement, they follow evidence, like earnings, dividends, and long-term growth, not today's headlines. Case Study 3: the hidden assets trap. This was about a company that had valuable assets, land, real estate, etc. Some investors thought, hey, this stock is undervalued because of all that land. They were right, but the land never got sold. The value never got unlocked. Lesson: Value investing is not just about what a company owns. It's about how and when that value can be realized. Paper wealth isn't enough. Look for catalysts or realistic pathways for that value to surface. Case Study 4. The Overvalued Favorite. A company had a great past, and people loved it. So they kept buying the stock at crazy high prices, even though the business had changed and wasn't doing as well anymore. Eventually, reality hit. The stock tanked. Lesson: past glory doesn't guarantee future profits. Even great companies can be bad investments if you pay too much. Chapter 18. Asserting yourself as an intelligent investor. In this final chapter of The Intelligent Investor, Benjamin Graham delivers a powerful closing message. He reminds us that being an intelligent investor isn't about having a high IQ or a degree from a top college. It's about character, discipline, and emotional control. Let's break it down simply. The core idea: who is an intelligent investor? An intelligent investor is patient, disciplined, and eager to learn. He or she doesn't let the market's mood swings dictate their decisions. Graham argues that markets will always fluctuate, sometimes wildly, but it's how you respond to these changes that defines your success. You don't need to predict the future of the market. You need to be prepared for it. 4 pillars of the intelligent investor. 1. Know yourself. Are you a defensive or enterprising investor? Your strategy must match your personality and lifestyle. 2. Focus on long-term value. Don't chase trends. Invest in assets that will grow over time, not hype. 3. Ignore the crowd. The market is often irrational. Don't buy just because everyone else is buying. 4. Safety. First, margin of safety is your best defense. Always assume that you might be wrong and prepare for it. Graham's final thought: the investor's chief problem, and even his worst enemy, is likely to be himself. Graham closes by reminding us that markets are unpredictable, but human behavior is consistent. Greed, fear, impatience, these are your real obstacles. But if you stick to your principles, stay rational, and remain humble, you'll not just survive the investing world, you'll thrive in it. Chapter 19. Shareholders and Management, Dividends and Corporate Governance. Imagine you're part owner of a company. You've bought its shares, and now you expect 2 things. Your money should grow. The people running the company, management, should act in your best interest. But does that always happen? Not really. This chapter is like a wake-up call. Benjamin Graham shows how company management sometimes forgets that shareholders are the real owners. The big idea. Graham says, a company is not the CEO's playground. It belongs to the shareholders. But over time, management becomes too powerful, and investors often stay silent, even when they're treated unfairly. 3 key focus areas. 1. Dividends, the investor's reward. Dividends are a company's way of saying, thank you for trusting us. Some companies don't pay dividends even when they earn good profits. Graham says that's wrong, unless the company reinvests that money wisely. If management hoards cash and does nothing meaningful with it. Red flag. The intelligent investor doesn't just look at profits. He asks, where is my share? 2. Corporate governance. Who's really in control? In theory, shareholders elect the board, and the board controls management. But in reality, management often selects friendly board members who never question them. The result: poor decisions, risky expansions, or hidden failures. Graham warns, if management acts like kings and shareholders like peasants, it's time to wake up. 3. The silent investor problem. Most investors are passive. They don't attend meetings, don't vote, and don't challenge bad behavior. Graham believes shareholders should behave like responsible owners. Speak up when needed. Otherwise, management gets away with poor performance. Real-life example. Graham discusses how companies often cut dividends, make silly acquisitions, or reward executives with huge salaries, and investors stay quiet. Imagine this. A company earns $1 billion in profit. It gives $900 million in bonuses to the top 10 managers and gives nothing to shareholders. Sounds crazy, right? But it happens. And Graham says, don't ignore it. Raise your voice. Bottom line for investors. Check dividend history. Is the company fair to its shareholders? Watch management's behavior. Are they working for themselves or for you? Be an active shareholder. Your silence is their power. Chapter 20. Margin of Safety as the Central Concept of Investment. This is the final chapter of The Intelligent Investor, and Benjamin Graham leaves us with the most powerful and timeless principle in investing: the margin of safety. It's not just a rule. It's a philosophy that separates smart investors from reckless ones. What is margin of safety? Imagine you're building a bridge that should carry trucks weighing up to 10 tons. But you design it to hold 15 tons. Why? In case of an error or an unexpected load, that buffer is the margin of safety. In investing, it's the same idea. You buy a stock for less than its intrinsic value, giving yourself a cushion if things go wrong. Graham's definition. Graham defines investing as an operation that promises safety of principal and an adequate return. And margin of safety is the built-in protection against unpredictable market behavior, poor analysis, or bad luck. Instead of trying to predict what the market will do tomorrow, smart investors focus on buying undervalued assets, those selling for less than they're really worth. How does this help? Protection against mistakes. If your estimate of value is wrong, the safety margin keeps you from losing much. Downside protection. Even if the stock market crashes, you'll likely lose less, or may even come out ahead. Avoiding speculation. It disciplines you to invest based on logic, not hype or emotion. Real-world example. Let's say you analyze a company and believe its real worth is $100 per share. If you only buy it when it's $70, you're building a 30% margin of safety. If you're wrong and it's worth only $85, you've still made a good deal. Graham's golden quote. Confronted with uncertainty, the intelligent investor will demand a margin of safety. He emphasizes that future is always uncertain, no matter how good your analysis is. That's why this principle is the bedrock of investing, the mindset shift. This chapter is a wake-up call. It tells us not to aim for maximum returns, but for safe, satisfactory returns, the kind that build real wealth over time. Investors often get greedy, but Graham teaches us, don't chase hot stocks. Don't invest in dreams. Look for reality and buy it only when it's on sale. Final takeaway. If you forget everything else from the book, remember this. The margin of safety is the secret weapon of the intelligent investor. It's the difference between gambling and investing. Build it into every decision, whether you're buying a house, a business, or a stock. In the long run, this principle alone can make you wealthy. Quietly, steadily, and safely.